Okay, so hello, good morning, and welcome to this video. In this video, the objective is to walk you through some consolidation adjustment that students mostly found confusion in an exams. After the end of this video, I promise you that if you take this serious, you are going to find consolidation so easy and so attractive. So let us go through them one after the other. If this is your first time of watching a video on this channel, please don't forget to subscribe so that you get the future videos that will be posted on this topic. We are interested in making you pass your exams with ease. So let's start. So when we talk about PUP, this is one of the adjustments that can be so confusing, but PUP is really easy. So we have PUP, that is provision for unrealized profit made by the parent, and then we have provision for unrealized profit made by the subsidiary. So in the question, if the PUP is made by the parent, the treatment is that it will affect two things. It will affect the group retained earnings, and it will also affect your inventory. So when you see PUP made by the parent, what you do is you subtract the figure from your retained earnings, and then you also subtract the figure from your group inventory, your inventory in the balance sheet. So that is the treatment for PUP made by the parent. If the PUP is made by the subsidiary, in other words, the subsidiary sold goods to the parent, and some of these goods are still in inventory. So you calculate the provision for unrealized profit, and in the accounts, it is also going to affect two things. It will affect your net asset at reporting and post-acquisition, and also your inventory. So you subtract the figure from your net asset at reporting and subtract from net asset at post-acquisition. And you also subtract the figure from inventory. So in all the two instances, PUP, either made by parent or subsidiary, the figure will definitely be subtracted from your inventory. I guess you get this right. Don't worry, if you don't get it right, in our next video, we are going to solve a question. So when we get there, you surely understand what I mean. Okay, so sometimes you will have intragroup transactions, be it cash in transit, goods in transit. So this is also sometimes causing differences in the balance sheet. So you see that one person or one entity will be recording this as cash in transit, another person, or otherwise in receivables, and then the other company recording it as payables. So in this instance too, it is going to affect our payables and then our receivables. So what you do is the difference, if any, should be added to cash. So we take the difference, we subtract from receivables, and then we subtract from payables. So that is in consolidation. You have to do this, subtract the figure from receivables, subtract from payables, because the parent is reporting, or the one who sold will be recording receivables, and the one who is buying will be expecting to receive something. So we deduct the figure from receivables and deduct from payables. The other adjustment is also the fair value adjustment. So with fair value adjustment, mostly what comes in an exam situation is PPE. So with PPE, you can get a question, they will tell you the acquisition date, the fair value of net assets, where the value of net assets were equal to their fair value, with the exception of, say, land or a building, which was in fair value excess. And those things, you'll be getting those things a lot. So with fair value adjustment, what we say is that, or what I have come out as a guide is that if the adjustment is an increase in PPE, if it is an increase in PPE, what you do is that you add it to net asset at acquisition, and then at reporting. You add it to net asset at acquisition and then reporting. And then you also add a figure to your PPE in the balance sheet. So if it is land and the figure has increased, let's say from 1,000 to 2,000, so the difference of 1,000 will be added to your net asset at acquisition and then at reporting, and then you also add the 1,000 to your balance sheet. And then because it is an increase, there's going to be a depreciation on the amount that it has increased by. So additional depreciation charge. So you are going to calculate the depreciation. So depending whether it is on a reducing balance or it is on a straight line basis. So I guess as for depreciation, when it comes, you can manage your way around. But if it is a decrease, if the fair value adjustment, it is a decrease, in that case, you are going to subtract it from your net asset at acquisition and reporting. And then you also subtract from your balance sheet. Just the opposite of what you do when it is an increase. All these things, I believe when we start to solve a question, the understanding is going to come more. Okay, so let's go to a fair value of NCI. Fair value of NCI. So mostly NCI will be valued whether based on fair value method or on a proportional basis. If it is on fair value, if NCI is valued using fair value, in that case, NCI will have a share of the goodwill. NCI will have a share of the goodwill. So we will take the figure to our goodwill calculation, and then it also affects our NCI calculation. But where it is on proportional basis, NCI will not have a share of the goodwill. NCI will not have a share of the goodwill. So please take note of this. If it is on fair value basis, I said NCI will have a share of the goodwill. So in calculating our goodwill, it's going to be our cost of investment. Then we add the value of NCI, and then we take off our net assets to get our goodwill at acquisition. And if there's any impairment, we take it off to get the goodwill at reporting. So please take note. Then sometimes in the question, you will get preference dividend. You get preference dividend as part of your additional information. So when there's a preference dividend, this is what you look out for. If the question tells you that it is accounted for, the preference dividend is accounted for, then it means that you are going to subtract it from payables or preference dividend, and then you also subtract it from receivables. But where it tells you that it is the preference dividend is yet to be accounted for, in that case, we'll add it to our group retained earnings, and then we subtract from our payables or preference dividend. So let's take note. Yeah, so you remember we mentioned our PUP made as the first point we spoke about. So PUP made by parent, you know that it is also going to affect your cost of sales. And if it is made by the subsidiary, yeah, it will still affect your cost of sales. So this is the P&L aspect, the P&L aspect. Yes. If there's an intra-group sales, you subtract from your revenue or turnover, you also subtract from your cost of sales. If there's an increase in fair value adjustment to PPE, you subtract from the depreciation on it is going to be taken from your cost of sales or expenses. Then depreciation on fair value decreases. You are going to subtract it from your cost of sales. So depreciation on fair value increases is going to be added to your cost of sales, but if it is a decrease in PPE, you add it to your cost of sales. And then, as usual, impairment is going to be added to your administrative expenses. Administrative expenses. So in a question where control is not gained, but you have the status of an associate, let's say 25% above, you have the status of an associate. So in this case, this is how you will be able to calculate the investment in associate, which is going to be a one-line item in your balance sheet. So you take the cost of investment, then share of post-acquisition profit. Then you also add your share of PUP if it is made by the parent. Your share of the PUP if it is made by the parent, then impairment of associate, if there's any. When you subtract that, you get your investment in associate. And here it is just the same. The company balances, if that is, it is in payables and receivables, and this is eliminated because associate is not consolidated. You don't consolidate associate. Yes, so we also have forms of consideration. This is mostly a very confusing area. If you don't get it right, it makes your whole work difficult. So the easiest one is cash. As for cash, the question will tell you that you purchase 50%, 51%, 60% of the associate and pay the cash consideration of this. So this one is always straight out. But where the confusion is, where you exchange shares, where there's a share exchange. So with share exchange, to calculate the cost of investment, we take the number of shares acquired by the parent and then multiply by the share price of the parent. You multiply by the share price of the parent, or the percentage of holding of the parent times the number of shares in the subsidiary times the share price of the parent. So what should be needed here is the number of shares that the parent has acquired. Then you also find the share price of the parent, not the subsidiary, the share price of the parent. So when you multiply the share price by the number the parent has acquired, you get the cost of investment. And this, you will need it in your goodwill calculation. And then you also add it to your equity or ordinary shares in the consolidated statement of financial position. The shares that have been acquired, you add it to your equity in the goodwill, in your balance sheet as part of your equity. Then we have deferred or contingent consideration. Where there's a deferred consideration, deferred means that the money will be paid in the future. So in that case, you have to get the amount and then you discount it. You multiply the amount by the discount factor. You have to discount it to present value. So, and the formula is the amount to pay in the future times 1/1 plus R, where R is the rate of return, all into bracket raised to the power n, and n is the number of years. Yes, so once you get that, you also add it. That is what you use for your goodwill calculation as cost of investment. And then you also add it to your non-current or current liabilities, depending on when the payment will be made, because it is something you pay in the future, so you have to add it to your liabilities. Yes. Then we have amount of unwound interest. Once there's a deferred payment, there's going to be an unwound interest, which is going to be the cost of capital times amount of deferred consideration calculated in I above. So basically, we will take a question in our next video to demonstrate this adjustment so that it makes easier for you. But in a real exam situation, when you don't have time or you have actually studied these things, but there's no time to go back and then do this revision, or something is so confusing, you can just refer to this video, look at how the particular thing is treated here, then in the exams, you just apply. That is the main purpose of making this video, to make things easier for you to pass your exams. So please don't forget to subscribe to get the next video, which will be basically or based on calculations incorporated of this adjustment. So I see you in the next video. For now, stay tuned. Bye.